The secret reason America will lose the trade war and how they hid it. They tell you we're fighting a trade war against China. They tell you it's about tariffs on steel girders and aluminum sheets. They tell you it's about a global competition where two giants are battling for the future of the world economy. They want you focused on the tariffs, the press conferences, and the empty rhetoric coming from Washington. But listen closely, because what they are telling you is a lie. This isn't a trade war, it's a controlled demolition. The enemy isn't overseas, it's right here in New York City. The problem isn't a lack of American ingenuity or a lazy workforce. The problem is a financial system that has decided it's more profitable to close down our factories and ship our jobs overseas than to build a stable economy at home. The American economy is like a magnificent, high-end super yacht. On the top deck, you have the champagne bottles, the glistening swimming pools, and the wealthy elites in their tailored suits. They tell you the ship is sailing smoothly, but down in the engine room, the mechanics are quietly removing vital engine parts and selling them for scrap metal. They are drilling holes in the hull and laughing while the water floods in. The mainstream media and the politicians are the band playing music on the top deck while the ship slowly sinks beneath the waves. They want you focused on the latest political scandal, the daily market swings, and the empty promises of a reshoring initiative that will never happen. The hidden reason America is losing the trade war is a four-letter word: debt. We have built an entire economy on the financial engineering of debt, not on the solid foundation of productive manufacturing. We sold our manufacturing base for cheap consumer goods and high-priced financial instruments. We traded real wealth for paper promises. And now we are paying the price. This isn't just about a few factories closing in Ohio or Michigan. This is about the total collapse of our supply chain. This is about the end of the US dollar's reign. This is about your empty wallet, your shrinking savings account, and the feeling that something fundamental in this country has gone horribly wrong. The trade deficit isn't a sign of strength. It's a wound that's bleeding our national wealth. The trade war isn't a fight we can win. It's a fight we started against ourselves, and we have already lost. This documentary pulls back the curtain on the greatest financial deception in modern history. We are going to expose the hidden mechanics of how Wall Street dismantled America's industrial might, chapter by chapter, and exactly what you can do to protect your family from the coming storm. The propaganda of protection isn't the propaganda, the tariff lie. The official story from Washington and the media talking heads is simple: China cheats. They say China manipulates its currency, steals intellectual property, and heavily subsidizes state-owned enterprises SOS to undercut American businesses. To protect our workers, they argue, we need tariffs. Tariffs are taxes on imported goods. The logic goes like this: if a Chinese-made widget costs $10, we slap a 25% tariff on it, making it cost $12.50. This creates a level playing field for the American-made widget, which also costs $12.50. This, they claim, saves American jobs and brings manufacturing back home. But here's the problem: tariffs don't actually solve the core issue. They are like putting a Band-Aid on a gunshot wound. The underlying structural damage to America's industrial base is far too severe for a simple tax adjustment to fix. The political rhetoric focuses on tariffs because it gives politicians a strong, aggressive stance on trade that plays well with voters, while completely ignoring the actual mechanisms that are destroying our economy. The media coverage focuses on specific products like steel or semiconductors, as if the trade war were a series of isolated battles rather than a systemic defeat. The hidden mechanics, the financialization trap. The truth is that America's trade problem isn't caused by China. It's caused by Wall Street. The core issue is financialization. For the last 50 years, U.S. economic policy has prioritized the financial sector, banking, hedge funds, insurance over the productive sector, manufacturing, agriculture, energy. The U.S. dollar is the world's reserve currency. To maintain this status, the U.S. must constantly export dollars to the rest of the world. Foreign central banks and large corporations need dollars to conduct international trade, especially in commodities like oil, the petrodollar system. This demand for dollars keeps the value of the dollar high. Now, here is the critical part: a strong dollar makes imports cheap and exports expensive. If you are a U.S. manufacturer trying to sell your products overseas, a strong dollar makes your goods unaffordable for foreign buyers. At the same time, a strong dollar makes foreign goods incredibly cheap for American consumers. This creates the trade deficit. America imports more goods than it exports. This trade deficit is the necessary price we pay to maintain the dollar's status as the world reserve currency. Wall Street loves a strong dollar because it allows them to invest globally, buy foreign assets cheaply, and attract capital from all over the world. But Main Street hates it because a strong dollar destroys manufacturing jobs. The victim-villain story, Bob the factory worker versus Chad the hedge fund manager. Picture this: Bob works at a medium-sized factory in Ohio producing high-quality metal components for industrial machines. Bob has worked there for 20 years, earning a good wage. He has a mortgage on a modest home and 2 kids in college. Bob's factory is competing with a Chinese factory that produces similar components. When the US dollar strengthens against the Chinese yuan, Bob's products automatically become 10 to 15% more expensive overseas, while the Chinese components become 10 to 15% cheaper for US buyers. Bob's company, facing declining sales and increasing costs, decides to close down its operations in Ohio. Bob loses his job, his savings dwindle, and he faces losing his home. Now look at Chad, a hedge fund manager in Manhattan. Chad doesn't care about metal components. Chad profits from currency arbitrage. He takes a large loan in US dollars, which are low interest thanks to the Fed, and invests it in emerging market bonds, which have high interest rates. Chad profits from the interest rate differential. A strong dollar makes Chad's investments look secure and profitable. When Bob's factory closes, Wall Street cheers because it signifies the capital shift from manufacturing to finance. Historical parallel: the Nixon Shock 1971. The roots of this problem trace directly back to August 15, 1971, when President Richard Nixon unilaterally ended the gold standard. Before 1971, the dollar was convertible into gold at a fixed price. This limited the government's ability to print money and kept the U.S. trade balance relatively stable. When Nixon closed the gold window, he detached the dollar from any physical backing. The U.S. government could now print money at will. This created the modern system where the dollar's value is determined by faith and demand from foreign central banks. The Nixon shock opened the door for massive, uncontrolled trade deficits. It allowed for the financialization model we see today, where Wall Street can create infinite leverage and profit from debt while our industrial base slowly rusted away. The end of the gold standard allowed the financial sector to disconnect completely from the real economy, laying the groundwork for the trade war defeat decades later. The currency manipulation smokescreen, the propaganda. China's manipulative currency. The mainstream narrative screams about China's currency manipulation. They claim that China deliberately keeps the yuan undervalued against the dollar to make its exports cheaper. This creates an unfair advantage, allowing Chinese goods to flood global markets while simultaneously making American exports prohibitively expensive. The U.S. Treasury regularly monitors China for currency manipulation, using complex economic indicators to determine if China is intervening in foreign exchange markets. The media paints a picture where China's central bank, the People's Bank of China, PBOC, holds huge reserves of US dollars and constantly buys dollars to weaken its own currency. This, they argue, is a direct attack on American jobs and a violation of free trade principles. The solution, according to this narrative, is for the US to force China to revalue its currency, letting the yuan strengthen against the dollar. The hidden mechanics, the Fed's role in currency weakness. Here's the inconvenient truth: the US dollar's strength or weakness isn't solely determined by other countries. It's determined by the US Federal Reserve. The Fed's actions, specifically its interest rate decisions, have a far greater impact on currency valuation than anything China does. When the Fed implements quantitative easing QE, it prints trillions of new dollars and buys up bonds. This floods the system with liquidity. When there is more supply of a currency, its value relative to other currencies decreases. This is a deliberate form of currency debasement. Conversely, when the Fed raises interest rates, quantitative tightening or QT, it makes the dollar more attractive to foreign investors seeking higher returns. This strengthens the dollar. The Fed's primary mandate is domestic, to maintain price stability and maximize employment, but its actions have massive international consequences. The U.S. benefits from a strong dollar when it wants to import cheap goods and raw materials, but it suffers from a strong dollar when it wants to export goods and services. The Fed essentially has to choose between a Wall Street dollar strong and a Main Street dollar weak. Historically, Wall Street has won every time. The victim-villain story, the exporter versus the consumer. Let's imagine a U.S. company, Exporter Inc., that sells high-quality industrial machinery to European clients. Their products are valued for their precision and reliability. Exporter Inc. calculates its costs in US dollars and sells to clients who pay in euros. When the dollar strengthens against the euro, the European clients suddenly have to pay more euros to get the same dollar value. Exporter Inc. loses sales. They have to lay off employees and cut production. Now let's look at the average American consumer. When the dollar strengthens, imported goods like electronics, clothing, and cars become cheaper. The consumer benefits from a lower price tag on their new iPhone, creating an illusion of prosperity. The politicians and media praise the low inflation, but they hide the fact that this deflationary force on goods is destroying domestic manufacturing jobs. The consumer gets a cheap TV today but loses their job tomorrow when the factory closes. Historical parallel: the Triffin dilemma. The problem of the US dollar's role in global trade was articulated by economist Robert Triffin in the 1960s. The Triffin dilemma states that a reserve currency country faces a fundamental contradiction. To meet global demand for dollars, a country must constantly export dollars, leading to trade deficits. However, these trade deficits eventually erode confidence in the value of the currency, causing foreign holders to dump their reserves and leading to the currency's collapse. America has been living with this dilemma for decades. We export dollars to maintain global liquidity, but this process forces us to run massive trade deficits. This system is unsustainable. The currency manipulation narrative against China is a smokescreen designed to distract from the fact that the US faces an inherent structural problem caused by its own reserve currency status. We are the ones manipulating the system by demanding the world accept our paper dollars in exchange for real goods. The factory floor exodus and financialization, the propaganda, automation, and market efficiency, the official line for why manufacturing jobs have evaporated from places like the Rust Belt is technological advancement and increased efficiency. They point to automation, robotics, and improved supply chain logistics. They argue that a single machine can now do the work of 100 people, so factory closures are simply the result of progress. We are moving from a brawn economy to a brain economy, and workers need to adapt by learning new skills and moving into service industries or technology. This narrative frames job losses as inevitable and natural, minimizing the pain and absolving policymakers of responsibility. It suggests that the U.S. economy is simply evolving, and those left behind are victims of history, not victims of policy. The hidden mechanics, the share buyback scourge. The real hidden mechanic driving the factory floor exodus isn't automation, it's financial engineering. When a company earns profit, it has three options: invest in new equipment capex, increase employee wages, or distribute cash to shareholders through dividends or stock buybacks. In a healthy economy, companies invest in new equipment and R&D. But since the 1980s, driven by Wall Street demands for quarterly results, companies have increasingly prioritized stock buybacks. A stock buyback reduces the number of shares outstanding, instantly increasing earnings per share EPS, which boosts the stock price. This benefits management, who are often compensated in stock options, and large institutional investors. Instead of investing in a new factory or modernizing equipment, a CEO faces pressure from activist investors to maximize shareholder return by closing down an old factory, selling the land for real estate development, and using the proceeds to buy back shares. This decision generates instant returns for Wall Street but destroys long-term productive capacity for Main Street. The victim of villain story: Susan, the small business owner versus the private equity firm. Susan owns a small machine shop in Indiana. Her shop produces components for a larger industrial company, which, in turn, supplies parts to a major automotive manufacturer. Susan needs new CNC machines, computer numerical control, to keep up with foreign competitors who have lower labor costs. She needs a loan from the bank. The bank looks at Susan's business model. It's stable, but low margin. The bank, however, can make far higher returns by investing in complex derivatives or high-interest financial products for a large private equity firm. The bank denies Susan's loan. Susan can't modernize her machinery. She slowly loses contracts to foreign competitors and eventually has to close her shop. Now let's look at the private equity firm. They buy out the larger automotive manufacturer, Susan's client. They immediately fire the existing management, sell off non-core assets like Susan's contracts to foreign suppliers, issue new bonds loading the company with debt, and take a large dividend for themselves. They then run the company into the ground, declare bankruptcy, and leave the pension funds and employees with nothing, all while having extracted millions in management fees. Historical parallel: the Rust Belt's decline 1980s. The process began in earnest in the 1980s, when faced with global competition from Japan and Germany. American manufacturing companies had a choice: invest in new technology, reorganize production like Toyota's just-in-time model, and focus on quality, or lobby Washington for protectionist tariffs and financial deregulation. They chose deregulation. The decline of the Rust Belt wasn't inevitable, it was a policy choice. The shift from a productive economy where wealth is created by making things to a financial economy where wealth is created by manipulating paper assets happened because it was more profitable for the political donor class. The financial industry lobbied for deregulation that allowed them to engage in risky financial practices while the manufacturing base withered away. The supply chain mirage, the propaganda, reshoring, and national security, the mainstream narrative shifted during the COVID-19 pandemic. Suddenly, the media started talking about supply chain resilience and national security. They highlighted the fact that America relied on foreign countries, mostly China, for everything from pharmaceuticals and medical equipment to microchips and rare earth minerals. They argued that we needed to reshore manufacturing to protect ourselves from future crises. Politicians held press conferences in front of empty warehouses, promising to bring back jobs and create new industrial capacity. They allocated billions of dollars in subsidies for semiconductor plants and battery factories. The official lie is that this reshoring initiative is happening now and will solve our vulnerability problems. The hidden mechanics, the cost and complexity barrier. The hidden truth is that reshoring is a pipe dream. The manufacturing supply chain is not a simple linear process. It's an incredibly complex ecosystem of specialized parts, highly skilled labor, and specific infrastructure. When you dismantle this ecosystem over decades, it takes decades to rebuild, if it can be rebuilt at all. For example, a modern semiconductor factory costs tens of billions of dollars and takes many years to build. But building the factory is only half the battle. You need the highly specialized equipment like ASML lithography machines and the highly skilled engineers to run them. America's educational system has prioritized soft skills over hard engineering, meaning we lack the workforce to staff these new factories. Most importantly, the reshoring effort fails because of the high cost of U.S. labor. Companies won't move back unless they can compete on price, and the U.S. wage structure, even with automation, makes it difficult to produce goods at the same price as in Asia. The U.S. government tries to bribe companies back with subsidies, but this just shifts the cost from consumers to taxpayers. The fundamental economic reality remains unchanged. The U.S. dollar's strength and high labor costs make manufacturing here unprofitable without massive government intervention. The victim a villain story, the empty warehouse versus the shipping cartel. Picture a small U.S. town that used to be a hub for textile manufacturing. The factories are now empty, boarded-up buildings. The town's infrastructure, from its specialized waste water treatment plants to its industrial power grid, is obsolete. A politician promises to bring back a new high-tech factory to this town. The town waits for years, but the factory never comes. The subsidies go to large corporations that build plants in existing high-tech areas or simply take the money and use it for stock buybacks. Now look at the shipping cartel. The U.S. relies almost entirely on overseas shipping for its consumer goods. The cost of shipping containers skyrocketed during the pandemic. Shipping companies enjoyed record profits. The U.S., having dismantled its domestic manufacturing capacity, is entirely reliant on foreign shipping lines for its essential goods, giving these cartels enormous power and further draining U.S. dollars from the economy. The cost of shipping is high because the demand for imported goods is constant, while the capacity to ship them is concentrated in the hands of a few powerful foreign companies. Historical parallel: the pre-war industrial base 1940s. During World War II, America's industrial might was unparalleled. The U.S. was the arsenal of democracy. Factories quickly converted from making cars to making tanks, and from making washing machines to making bombers. This industrial base was robust, flexible, and capable of quickly scaling up production in response to national needs. Today, that capability is gone. The U.S. cannot rapidly scale up production of critical components without relying heavily on foreign suppliers. The supply chain has become a globalized web where the U.S. is often the end consumer, not the producer. The rhetoric of reshoring today is a faint echo of America's past glory, but it fails to address the current reality that our industrial base has been hollowed out by decades of financialization and policy negligence. The Fed's interest rate trap, the propaganda, fighting inflation with higher rates. The Federal Reserve's primary narrative for the past few years has been about fighting inflation. They tell us that the cause of inflation is overheated demand and pandemic supply shocks. The solution, according to the Fed, is to raise interest rates. Higher interest rates slow down borrowing, reduce spending, and cool off the economy. The goal is to bring inflation down to a target of 2%. This narrative presents the Fed as the hero, bravely taking tough medicine to protect the American consumer from rising prices. The media frames Fed Chair Jerome Powell as a strong leader making difficult decisions in the face of economic uncertainty. The hidden mechanics, the dollar's strength paradox. Here's the brutal truth. The Fed's actions, while lowering inflation, are actively destroying America's ability to compete in the trade war. When the Fed raises interest rates, it strengthens the US dollar relative to other currencies. As we've established, a strong dollar makes imports cheaper and exports more expensive. The high interest rate policy of the Fed creates a massive incentive for global capital to flow into US dollar-denominated assets like US Treasury bonds because they offer a higher yield. This strengthens the dollar further. This creates a paradox. To fight inflation, the Fed strengthens the dollar. But a strong dollar widens the trade deficit by making imports cheaper and exports more expensive. The result is that the US manufacturing base, which is already struggling, is hit by a one-two punch. First, they face higher borrowing costs to finance new equipment because of higher interest rates. Second, they face stiffer competition from foreign imports that are now even cheaper because of the strong dollar. The villain story, Mike the home builder versus Jamie Dimon. Mike is a small home builder in Texas. He builds starter homes for middle-class families. Mike relies on short-term bank loans to finance construction projects. When the Fed raises interest rates, Mike's borrowing costs skyrocket. He has to raise his home prices to cover the financing costs. The demand for homes collapses because mortgage rates are now too high for average families to afford. Mike has to lay off his construction crew. Now let's look at Jamie Dimon, CEO of JP Morgan Chase. Dimon runs one of the largest banks in the world. When interest rates rise, banks profit handsomely because they increase the interest they charge on loans and mortgages. Furthermore, the high interest rates attract massive inflows of capital from around the world into U.S. banks. Wall Street profits from high interest rates, while Main Street suffers from a collapsing housing market and rising unemployment. Historical parallel: Paul Volcker's shock 1979 to 1982. The current Fed policy echoes the actions of former Fed Chair Paul Volcker in the late 1970s and early 1980s. Faced with runaway inflation, Volcker raised interest rates to unprecedented levels. This successfully crushed inflation but also caused severe recessions and contributed to the deindustrialization of the American heartland. Volcker's policy prioritized the stability of the dollar above all else. This decision solidified America's shift toward financial dominance at the expense of manufacturing. The high interest rates made it nearly impossible for U.S. companies to compete globally, accelerating the transfer of industrial capacity overseas. The current Fed policy, while claiming to fight inflation, is following the same blueprint that destroyed American manufacturing 40 years ago. Mid-roll break. If you're still watching, it means you understand that the official story is a complete lie. You realize that your savings are being destroyed by policies designed to benefit the financial elite. This isn't just about money. This is about freedom. It's about being free from the manipulation of central bankers and politicians who control your financial future. If you value true freedom, type the word freedom in the comments below. The energy equation and resource depletion. The propaganda. U.S. energy independence. The media often celebrates America's energy independence. They boast about the U.S. being a major producer of oil and natural gas thanks to the fracking revolution. They argue that this gives the U.S. enormous geopolitical leverage and makes us less reliant on foreign energy sources. The narrative suggests that cheap domestic energy is a major competitive advantage for U.S. industry, ensuring low costs for manufacturing and transportation. The hidden mechanics, the export pipeline. The hidden truth is that energy independence has actually become a liability for U.S. manufacturing. The U.S. is exporting massive amounts of energy. U.S. oil and natural gas, liquefied natural gas or LNG, are now sold on the global market, meaning U.S. domestic prices are linked to global prices. Here is the key insight. When a manufacturing base relies heavily on a cheap domestic energy supply, as the U.S. did from the 1950s to the 2000s, it is a cost advantage over foreign competitors. But when the U.S. exports its energy, domestic prices rise to global levels. This destroys the cost advantage for U.S. factories. U.S. chemical plants, for example, rely on cheap natural gas as both a fuel source and a raw material feedstock. When the price of natural gas rises due to exports, U.S. chemical plants lose their cost advantage against foreign competitors who might be getting subsidized energy or have access to cheaper feedstock. The victim-villain story: Mark, the chemical plant owner, versus the global energy trader. Mark owns a chemical plant in Louisiana. He uses natural gas to power his facility and as a key component for his products. When U.S. natural gas prices were low, Mark could easily undercut foreign competitors. He employed hundreds of people and expanded his operation. Then, the U.S. began exporting LNG heavily to Europe and Asia. The demand for U.S. natural gas increased dramatically and prices rose. Mark's costs increased significantly. He can no longer compete with foreign companies that are getting cheaper energy or subsidies from their governments. He has to raise his prices, lay off workers, and eventually sell his plant to a larger corporation that will move production overseas. Now consider the global energy trader. This trader buys massive quantities of natural gas in the U.S. at the lower domestic price, ships it overseas as LNG to Europe where prices are higher, and sells it at a huge profit. This process drains U.S. energy resources and capital from the country while enriching the traders. The U.S. exports raw resources and imports finished goods, a classic colonial economic model. Historical parallel: the 1970s oil shocks. During the 1970s oil shocks, the U.S. learned a painful lesson about relying on foreign energy sources. The high price of oil caused inflation, recessions, and a decline in industrial activity. The solution was supposed to be energy independence. But today's situation is a perversion of that goal. Instead of using energy independence to bolster domestic manufacturing, U.S. policy allows for the export of energy resources to fuel foreign economies. This demonstrates that the U.S. policy priority is to protect the financial system, the petrodollar, rather than to protect the domestic industrial base. The U.S. uses its energy leverage not for domestic benefit, but for geopolitical influence, even if it harms Main Street. The commodity supercycle and resource scarcity. The propaganda: inflation is transitory. For many months, the Federal Reserve insisted that inflation was transitory. They blamed temporary supply chain disruptions and pent-up consumer demand from the pandemic. The media echoed this, arguing that prices would soon return to normal as production caught up. The narrative downplayed the role of monetary policy and focused on isolated factors like used car prices or lumber costs. The hidden mechanics: currency debasement and commodity price rises. The real driver of the commodity supercycle is monetary policy. When central banks print vast quantities of money, quantitative easing, and keep interest rates near zero, they debase the currency. The purchasing power of the dollar declines. This causes investors to flee paper assets and seek safety in hard assets and commodities. The prices of copper, lithium, gold, silver, and other critical resources skyrocket because they maintain their value relative to the debased currency. The problem for U.S. manufacturing is twofold. First, the U.S. has outsourced most of its mining and processing capacity to other countries, primarily China. We are almost entirely reliant on foreign sources for essential components of modern technology, such as rare earth minerals and lithium for batteries. Second, when U.S. factories try to produce goods, they must compete with foreign buyers for these inflated commodities. The U.S. factory must pay the high global commodity price in dollars, but its foreign competitor might be getting subsidized prices from a state-run enterprise or simply paying in a local currency that isn't as inflated. The victim-villain story: Mary, the battery plant manager, versus the commodity speculator. Mary manages a U.S. factory that assembles electric vehicle batteries. Her company imports lithium and other rare earth minerals from overseas for processing. Mary's costs are determined by global commodity prices, which are rising rapidly due to currency debasement and speculation. Mary's foreign competitors, however, have direct access to subsidized materials from state-run processing plants. They also benefit from a currency that is lower relative to the dollar. Mary cannot compete on price. She has to raise her prices, making her U.S.-made batteries more expensive than foreign-made ones. Now look at the commodity speculator. This speculator profits by buying up futures contracts for copper and lithium before the price rises. They don't actually produce anything, they simply profit from the monetary instability created by the central bank. The speculator buys a private jet while Mary's factory struggles to survive. Historical parallel: the denarius debasement. Roman Empire. A clear historical parallel for currency debasement and commodity price rises can be found in the Roman Empire. The denarius was initially a silver coin. Over centuries, Roman emperors gradually reduced the silver content of the coin to fund military campaigns and state expenditures. By the 3rd century AD, the denarius contained almost no silver, becoming essentially worthless. This debasement led to rampant inflation. As the currency lost value, people hoarded tangible goods and precious metals. The Roman economy collapsed and trade became difficult. The Roman government tried to fix prices, but this only made matters worse. The collapse of the currency directly correlated with the decline of the empire. America's current monetary policy mirrors this historical pattern. By constantly debasing the dollar, we are creating a resource scarcity crisis for our own industries, making us dependent on foreign nations that control the processing of these resources. The financialization monster, the propaganda. Wall Street creates value. Wall Street's propaganda machine insists that finance is the engine of the economy. They claim that derivatives, high-frequency trading, and complex financial instruments create liquidity, efficiently allocate capital, and ultimately create value for the productive economy. The media celebrates high salaries in the financial industry, portraying investment bankers and hedge fund managers as the smartest people in the room, innovating in complex markets. The hidden mechanics, the talent drain and misallocation of capital. Financialization creates a dangerous misallocation of resources and talent. The brightest minds coming out of universities are heavily incentivized to go into finance rather than engineering, manufacturing, or agriculture. The promise of millions and bonuses and a high-status lifestyle pulls talent away from productive sectors where they might have actually built things or solved real-world problems. This creates a self-reinforcing loop. As the manufacturing sector shrinks, fewer jobs are available for engineers and skilled technicians. As the financial sector expands, it sucks up more talent and capital. The result is an economy where the financial tail wags the productive dog. Capital is allocated to speculative ventures rather than long-term industrial investment. Why invest $1 billion over 5 years to build a new factory with an uncertain return when you can make $100 million in a few months on a complex financial transaction or stock buyback scheme? The victim-villain story. Alex the engineer versus the fintech billionaire. Alex is a brilliant engineer with a groundbreaking idea for a new, efficient manufacturing process. He needs venture capital funding to build a prototype and start production. He presents his detailed business plan to a venture capital firm. The firm declines. They deem the investment too high risk and too long-term. Meanwhile, the same venture capital firm invests billions of dollars in a new fintech app. The app's business model involves high-risk lending to consumers or a complex digital currency scheme. The app generates massive fees and commissions for the venture capital firm and allows them to sell the company in a high-profile initial public offering (IPO) in just 2 years, long before the app even proves sustainable. Alex's manufacturing idea, which would have created real jobs and real wealth, never gets off the ground. The fintech app creates massive profits for a few insiders but provides little productive value to society. This misallocation of capital is a symptom of a financialized economy. Historical parallel. The Dutch tulip mania 1637. The most famous historical example of a speculative bubble fueled by financialization is the Dutch tulip mania in the 17th century. During this period, the price of tulip bulbs skyrocketed far beyond their intrinsic value. People began trading futures contracts on tulip bulbs, creating complex financial instruments based on speculation rather than actual production. At the peak of the bubble, a single tulip bulb could sell for more than a house. When the bubble inevitably burst, it caused widespread panic and financial ruin across the Netherlands. The capital that was diverted into this unproductive speculation disappeared, leaving behind a generation of economic instability. America's current financialization of everything, from housing to crypto to stock buybacks, mirrors this historical pattern where speculative paper wealth takes precedence over real, tangible value. The debt bomb and foreign creditors. The propaganda. Government spending stimulates the economy. Politicians in Washington constantly argue that government spending is necessary to stimulate economic growth. Whether it's infrastructure bills, military budgets, or social programs, they insist that spending creates jobs and improves quality of life. The media typically reports on these expenditures by highlighting the immediate benefits to local communities, ignoring the long-term cost and how it must be financed. The hidden mechanics. The creditor constraint. The U.S. national debt now stands at over $34 trillion. This debt must be financed. When the U.S. government runs a deficit, it issues treasury bonds. These bonds are bought by individuals, corporations, and, most importantly, foreign central banks like those in China and Japan. Here is the hidden constraint. The U.S. must keep the dollar strong to ensure these foreign creditors continue buying our debt. If the dollar were to weaken significantly, the value of their U.S. Treasury holdings would decrease in their local currency. This would incentivize them to sell their holdings, potentially causing a run on the dollar and a crisis in U.S. financial markets. This requirement forces U.S. policymakers into a difficult bind. They cannot implement policies that would weaken the dollar to boost exports and help manufacturers because doing so might spook foreign creditors and cause a debt crisis. The victim-villain story, future generations versus current politicians. Picture a young couple graduating college today. They enter a labor market with few high-paying manufacturing jobs. They face high inflation on consumer goods and food. They will bear the cost of the massive national debt through higher taxes and reduced government services for decades to come. Now look at current politicians. They spend trillions of dollars on programs that secure votes for the next election. They borrow money today and push the costs onto future generations. The politicians are buying votes with borrowed money, knowing full well that they won't be in office when the bill comes due. The national debt is a form of hidden taxation on future generations, and it is a direct result of the financialized system's inability to generate real wealth through production. Historical parallel: Weimar Germany and hyperinflation. The most devastating historical example of unchecked government debt and currency debasement is Weimar Germany in the 1920s. Following World War I, Germany was forced to pay massive reparations. The government printed vast quantities of money to pay off these debts, leading to hyperinflation. The German mark became worthless. People used wheelbarrows full of cash to buy groceries. The middle class was completely wiped out. This economic chaos created a vacuum that led to political extremism and the rise of Hitler. While America is not yet facing Weimar-style hyperinflation, the underlying mechanics are similar. Printing money to pay for government debt inevitably leads to currency collapse and societal instability. The U.S. trade deficit and national debt are two sides of the same debasement coin. The BRICS challenge and de-dollarization. The propaganda: BRICS is a minor threat. The mainstream media minimizes the BRICS alliance: Brazil, Russia, India, China, South Africa as a collection of developing nations trying to challenge the U.S. dollar but ultimately failing due to internal disagreements and economic instability. They argue that the U.S. dollar's dominance is unassailable because there is no viable alternative currency for global trade. The hidden mechanics: the quiet de-dollarization movement. The hidden truth is that a powerful de-dollarization movement is underway, and it poses an existential threat to the U.S. trade deficit model. The U.S. dollar's dominance allows America to run massive trade deficits without facing immediate consequences because the rest of the world needs dollars for trade. If the world stops using the dollar, this privilege disappears. BRICS nations are actively building alternative payment systems and promoting trade in local currencies. Russia, for example, is now selling its oil to India and China in Indian rupees and Chinese yuan, completely bypassing the U.S. dollar. China has created CIPS cross-border interbank payment system as an alternative to SWIFT, the U.S.-controlled international payment system. This shift is accelerating because the U.S. has weaponized the dollar through sanctions. When the U.S. freezes a nation's dollar reserves as it did to Russia, it signals to every other country that their dollar holdings are not safe. This pushes countries to find alternatives. The victim-villain story: the U.S. consumer versus the BRICS central banker. The U.S. consumer relies on cheap imports made possible by the strong dollar. If de-dollarization accelerates, demand for dollars will fall. The dollar's value will decrease. This will make imports significantly more expensive, leading to massive inflation for the U.S. consumer. The U.S. consumer, who has become addicted to cheap goods, will suddenly face a massive reduction in their purchasing power. Meanwhile, the central bankers in BRICS nations are quietly accumulating gold reserves. Gold is the ultimate hard asset. When countries no longer trust the U.S. dollar, they turn to gold. The BRICS central banks are stocking up on gold bars to protect their economies from the coming dollar collapse. The BRICS central banker prepares for a new world order while the U.S. consumer struggles with rising prices. Historical parallel: the decline of the British pound sterling. For centuries, the British pound sterling was the world's reserve currency. The British Empire controlled global trade and finance. However, after World War II, the U.S. dollar, backed by the largest industrial economy in the world, began to replace the pound. The Bretton Woods Agreement in 1944 formalized this shift. The decline of the pound sterling led to a period of economic instability in the UK, often referred to as the sick man of Europe. The UK lost its financial dominance and its ability to run large trade deficits. The US is following a very similar path today. We are losing our industrial base, running massive trade deficits, and watching as other nations prepare to replace the dollar. The trade war is a smokescreen. The real war is the de-dollarization movement that will end America's financial dominance. The survival roadmap of the trade war isn't just about tariffs or manufacturing jobs. It's about a fundamental shift in global power and the collapse of the financial model that has underpinned American prosperity for the last 50 years. The system is rigged against you, designed to extract wealth from Main Street and consolidate it on Wall Street. The game is changing, and if you stay on the top deck of the sinking super yacht, you will go down with it. The good news is that you don't have to be a victim. You can take steps now to insulate yourself and your family from the coming financial storm. This is the survival roadmap for the new economy. 1. Escape paper assets. The illusion of wealth. You must understand that a significant portion of your net worth is tied up in paper assets, stocks, bonds, and savings accounts that are denominated in US dollars. As the dollar debasement continues, the purchasing power of those assets will shrink. The value of your 401k or retirement account might look good on paper, but if inflation is 10%, you are actually losing purchasing power every single year. The first step is to recognize that cash is trash in a fiat system where the government prints money at will. Diversify out of paper assets and into hard, tangible assets that cannot be printed by a central bank. 2. Hard assets, gold and silver. Gold and silver have been stores of value for thousands of years. They cannot be created out of thin air by a central bank. As the dollar loses value, gold and silver typically rise in price because it takes more units of the debased currency to buy the same amount of metal. For thousands of years, gold has maintained its purchasing power. An ounce of gold bought a good Roman toga in ancient Rome, and an ounce of gold can still buy a tailored suit today. Gold is an insurance policy against monetary collapse. Silver, often called poor man's gold, serves a similar purpose but also has significant industrial uses. As a physical asset, silver is essential for solar panels and electronics. As the world reindustrializes, silver demand will increase significantly. 3. Digital scarcity. Bitcoin is the modern alternative to physical gold. It represents digital scarcity. Unlike traditional currencies, Bitcoin has a fixed supply of 21 million coins. No central authority can print more Bitcoin. It operates on a decentralized network, meaning no government or corporation can censor or control your assets. While volatile in the short term, Bitcoin is fundamentally a response to the problems created by financialization and central bank debasement. It is a hedge against a failing fiat system. A portion of your hard asset portfolio should be dedicated to Bitcoin as a form of digital gold, ensuring your wealth cannot be confiscated or inflated away. For productive assets, land, and skills, the most critical asset in a declining economy is productive capacity. This means owning land that can generate food or energy. Land cannot be moved overseas, and it cannot be printed by a central bank. Owning land in a high-growth area, or land that can produce food, provides true security against supply chain failures. Even more important than land are skills. In a world of financialization, the demand for truly productive skills, plumbing, electrical work, welding, carpentry, coding will increase dramatically. The trades offer high-paying, recession-proof careers. The ability to build and fix things is a form of wealth that cannot be inflated away. 5. Reduce debt and increase savings. The financialized system thrives on debt. When you carry high-interest credit card debt or a large mortgage, you are a slave to the system. You are forced to work to pay interest to the financial institutions that are destroying your future. Prioritize eliminating high-interest debt. Increase your savings rate. Hold your savings in hard assets, gold or silver, Bitcoin, to protect against inflation. By reducing debt, you free yourself from the financial system's leverage and ensure that you are no longer a victim of their manipulation. Conclusion: the choice, they call it a trade war, but it's really a war against productivity. It's a war where financial engineering has replaced real engineering. The hidden reason America is losing is because Wall Street decided to dismantle our industrial base to maintain the dollar's dominance and enrich itself. The choice is clear: you can continue to believe the propaganda and remain a victim of a system designed to fail, or you can take control of your financial future by moving your wealth from paper promises to tangible assets. The world is changing. The US dollar's reign is coming to an end. The question is, when the dust settles, will you be left with nothing but empty paper, or will you have prepared for the new reality?